welcome you all once again in the video lecture on one of the asset-based standard, which is Ind AS 2 inventories. So students, I took so many lectures with you in this particular batch, and today we are going to discuss about Ind AS 2 inventories. It's a it's a very important asset-based standard. If I talk from the weightage perspective, so probably 3 or 4 marks question could be asked from this particular standard. It's a very small standard, right? And if you have a knowledge of accounting standard 2, so there is a win-win situation for all of you. There is no much difference between AS2 and Ind AS 2, or I can say that there is no difference between accounting standard 2 and Ind AS 2. If you are a student of GFRS paper and you have elected GFRS, in that case, there is no difference between IAS2 and Ind AS 2. So accounting standard 2, Indian accounting standard 2 and international accounting standard 2, these three standards are exactly same. I can say that, right? So reading one standard will make you prepare for three standard. Is that clear? So once again, a very good morning to all of you. And I can see the response from Viraj and Mantha. Yes, guys, first of all, what is meant by inventories? How can you say that it is an inventory? For example, Maruti car. So if Infosys is buying a Maruti car, right, or Infosys wants to sell the Maruti car, is it an inventory for them? Answer is no. But car for Maruti Suzuki India Limited. Whether this car is inventory for Maruti Suzuki India Limited? Yes. So same car. So Infosys bought a car and now Infosys wants to sell this car because the Infosys management is not liking that car and they want to sell this car. So it is not an inventory, it is a PP, property, plant and equipment. And the moment they have decided to sell this car, probably it will become your non-current assets held for sale. It will come under Ind AS 105, right? But same car, when Maruti Suzuki India Limited wants to sell this car, it become inventory. It is an inventory. So the car lying with Infosys is property, plant and equipment. The car lying with Maruti Suzuki India Limited is an inventory. Why? Why? Namrata is saying inventory which is held for sale in the ordinary course of business, right? Even though Infosys wants to sell that car, right? Still it is not an inventory. Why? Because Infosys business is not to sell the car. Infosys business is to sell the software. Infosys business is to sell the software, right? ERPs. So, but the business of Maruti Suzuki India Limited is to sell the car. It means inventory are those items, those assets which is held for sale in the ordinary course of business, right? In the ordinary course of business. For example, me, you, we all are selling properties in our lifetime. ठीक है? किसी ने मकान खरीदा और एक मकान बेच दिया. If let's say I have bought a property, I bought a flat in Delhi and I want to sell this flat, that is not my inventory. But what about DLF? What about DLF? What about Amrapali? Right? What about Supertech? These are the real estate developers, right? They are selling flats. They are holding flats. They are holding properties for the purpose of sale in the ordinary course of business. So as rightly mentioned by Namrata, you need to look at, you are not go by the amount, you are not go by the item. कि सर अगर एयरक्राफ्ट है तो ये तो हमेशा पीपी होगा. नहीं. If aircraft is purchased by Indigo Airlines, Air India, it is PPE. But aircraft from Boeing, right? Boeing is a company which manufactures aircraft and their intention is not to fly the aircraft. Their intention is to sell the aircraft, right? Their intention is not to earn the money from using the aircraft. Their intention is to earn the money from selling the aircraft. So Boeing is manufacturing aircraft or holding aircraft for the purpose of the sale in the ordinary course of business, right? Although it is a made to order inventory. Okay. So these aircrafts are considered as an inventory. So inventory means those asset which is held for sale in the ordinary course of business. Mansha is saying, sir, for them, these come under operating activities. You're right. So Mansa has given an additional input and she told that, sir, normally the sale of these items comes under the operating activities. For example, if you will sell the property, plant and equipment, it will not come under the operating activities. It will come under the investing activity. Acquisition of property, plant and equipment, disposal of property, plant and equipment, these are come under the investing activities. We are right. So I believe I have set the context, and the good news for all of you is, since you are a CA final students, you have already crossed the hurdle of CA Inter or IPCC. And for you guys, AS2 is not a new thing. You just put IND before AS2 and your Ind AS is complete. That's all. Right? You find it fun? Okay. We are talking about inventories. Coming to the objective and scope, the objective is to prescribe the accounting treatment of inventories. Sir, why this standard? Because this standard takes care of inventories, right? How to? If I'm talking about inventories, what at what value inventory has to be measured on the initial recognition as well as subsequent measurement, right? On the transaction date, how will you value the inventory? On the reporting date, how will you work in progress arising under construction contract, including directly related services? The companies which are into road projects, right? They are constructing roads and they are getting money. So these are kind of contract assets. These are kind of contract asset, kind of a contract assets. So these kind of work in progress, because inventory includes raw material, work in progress, and finished goods. You all are aware? You all are aware about this fact? Inventory includes raw material, work in progress, and finished goods. So although this is a work in progress, you are constructing road, right? This is a work in progress, but this is not coming under Ind AS 2. This will come under Ind AS 115 because you will get a amount for your services, right? So this work in progress is known as a contract assets. So it will be covered under Ind AS 115. Financial instruments. If there are financial instruments, it will be covered under Ind AS 32 and Ind AS 109. It will not be covered under Ind AS 2. Biological assets related to agricultural activity. So biological assets, cow, buffalo, animals, plant. So these are covered under Ind AS 41 and this will not be covered under Ind AS 2. And agriculture produced at the point of harvest, right? When you are plucking the mangoes from the mango tree, at the point of harvest, Ind AS 41 is applicable to the agricultural produce, right? After that, Ind AS 2 will be applicable, but at the point of harvest, Ind AS 41 will be applicable, right? For example, Nestle. So Nestle has a mango orchard. Okay, they are plucking mangoes for the purpose of manufacturing of sauces, jams, and chutneys. So when at the point of plucking the mangoes, at the time of plucking the mangoes, it is a agriculture produce at the point of harvest, and this has to be measured in accordance with Ind AS 41, not Ind AS 2, right? So once it got plugged, it has been measured as per Ind AS 41. Then after that, Ind AS 2 will be applicable. But till that point of time, Ind AS 41 will be applicable. Measurement of inventory is held by producer of agriculture produce after harvest, right? Measurement of inventory is held by producers of agriculture produce after harvest. For example, again, Nestle. So they are measuring inventories which are held by producer of agriculture produce, right? So whatever is the value under Ind AS 41, it will become your opening value of the inventory. Okay. And commodity broker traders measuring inventory at fair value less cost to sell. If they are commodity broker traders like the broker of aluminum, copper, so these are the commodity broker traders, right? So they need to measure inventory at fair value less cost to sell. So these are the four items where Ind AS 2 will not be applicable. Otherwise, on all inventories, Ind AS 2 will be applicable. Is that clear? Yeah. Coming to the definition, guys, inventories are assets. Of course, we are talking about assets, right? It is a resource controlled by the entity. Inventories are assets which are held for sale. Only the word held for sale is not sufficient. it is important that held for sale in the ordinary course of business, right? In the ordinary course of business. So if Infosys is selling its building, Tata Motors is selling one of its building, although it is held for sale, but it is not held for sale in the ordinary course of business. And hence, the building sold by Tata Motors Limited will come under Ind AS 105, non-current assets held for sale and discontinued operations, right? Because that building is property, plant and equipment for Tata Motors Limited. But building sold by DLF, Amrapali, Supertech, right? Unitech. So building the M3M, building sold by these real estate developers is considered as inventory. Why? Because it is held for sale in the ordinary course of business. In the process of production for such sale, in the process of production for such sale. So here we are talking about finished goods, right? Here we are talking about finished goods. Okay. Here we are talking about in the process of production for such sale. In the process of production for such sale. Okay. Means work in progress. For example, the cement manufacturers purchases lime stock, right? So they are purchasing limestone and they are processing limestone for manufacturing of cement. Okay. Or when Maruti or Tata Motors is manufacturing cars, so they have to go through with a long scale of production, right? There is a production cycle, there is a process, there are stages, which is known as an assembly line as well. So once the steel needs to be given a shape, then electrical fitting has to be done, then paint has to be done, then engine needs to be placed, then the entire configuration has to happen, then the seats has to be inserted, all right, then lights has to be put in. So there is a process, right? There is a lot of raw materials which is required for manufacturing of cars. Okay, a lot of raw material like iron, steel, switches, wire, right? Clothes, foam, okay, plastic, lot of raw material is required. So stereo. So in that case, when this raw material has to be manufactured and then the process from raw material to finished goods, this is a journey, right? And what this journey is known about, this journey is known about work in progress. So work in progress is also covered here, right? For example, if the real estate developer is constructing a real estate project, it will take 3 years, 4 years, 5 years. So what is that? It is work in progress. Or in the form of material or supplies to be consumed in the production process or in the rendering of services, means raw material and other material or supplies as well. Raw material, it also includes packing material as well. We will discuss about packing material later on, right? So friends, what is inventory? Inventory is assets which is held for sale in the ordinary course of business, in the process of production for such sale, or in the form of material or supplies to be consumed in the production process or in the rendering of services, right? So your inventory means raw material, RM. When RM is going to be processed, it will become work in progress and your finished goods, right? Apart from these items, inventory also includes loose tools, right? Loose tools, standby equipments, spare parts, standby equipments, packing material, packing material. When I'm talking about packing material, it is a primary packing material, right? We'll talk about this, okay? So far, whether the definition of inventory is clear? So far, whether the definition of inventory is clear? Yeah. So definition of inventory is very important. Yeah. So Namrata is saying if process or production is not for sale, then not inventory. You are right, Namrata. For example, I am constructing, or let's say Tata Motors is constructing another plant or another factory, right? So what they are doing, they are putting labor, material for the construction, right? In that case, it is not a work in progress, it is a capital work in progress, right? It is a CWIP, which becomes a property, plant and equipment. Why? Because is not that process is not getting carried out for the purpose of sale in future. Okay. So, and that is why it is not a work in progress, it is a capital work in progress, CWIP. Okay. It is CWIP. Inventories are asset which is held for sale in the ordinary course of business, in the process or production of such sale, or in the form of material or supplies to be consumed. To be consumed means loose tools, lubricants, grease, oil, right? To be consumed in the production process or in the rendering of services, packing material. Okay. Like toothpaste. Can you get the toothpaste open? I mean to say whether the toothpaste is sold openly or toothpaste is stored in a tube and the tube has to be sold. So the toothpaste can be sold only in a tube. When you purchase milk, so milk is coming in the plastic packing, right? Like Amul, Parag milk, you must Mother Dairy milk, right? So these are known as a primary packing material. So this primary packing material is considered as a material or supplies, okay, to be covered under Ind AS 2. But you must have seen that Pepsodent. Pepsodent is a toothpaste. So toothpaste comes into a tube, right? Only then it can be sold. So the tube, that packing in the tube is considered as a primary packing material, which is important to get the inventory in the location and condition for sale, right? Otherwise, toothpaste cannot be sold. But apart from the tube, one hardboard, right? One paper board or one paper or cardboard type of box will be there for the Pepsodent toothpaste. So that is a secondary packing material for the purpose of transportation for, or let's say Maggie. When you buy the Maggie, so Maggie is stored in a plastic packing, right? And when you let's say when the Maggie is coming to the supplier or to the dealers, so it comes into the cartons, right? So these corrugated boxes, these are the secondary packing material for the purpose of transportation, distribution, right? So this is not a primary packing material. So the secondary packing material will be charged to P&L as it is. But the primary packing material will come under the inventory Ind AS 2. Why? Because it is a material or supply to be consumed in the production process or in the rendering of services. Without the primary packing material, the inventory cannot be sellable. Is that clear? Is that clear? Namrata, what is your query? Is that clear? Okay, Namrata is having a query in the objective part. So let me go there. Namrata, the first, I mean to say the second last point talks about biological assets related to agricultural activity and agriculture produce at the point of harvest. So the point number 3 is only talking about the item. Point number 4, last point, is talking about the measurement, right? So although this point, this part till this one, harvest, this part and this part may be clubbed, okay? So third point only talking about biological assets related to agricultural activity and agriculture produce at the point of harvest. These two items are excluded. And the fourth part categorically talking about a company who is having an in-house orchard, right? For example, Nestle, they are having an in-house mango orchard and they are plucking mangoes for getting it used as a raw material. So now the question arises, they are the producer of agriculture produce, right? So in this case, when they are harvesting mangoes from the tree, so whether that at that point of time, the mangoes are required to be measured as per Ind AS 41 or Ind AS 2, it has to be measured as per Ind AS 41. Why? Because, and why it is written there? Why it is written here? Because under Ind AS 41, the formula is or the method is agriculture produce at the point of harvest has to be measured at fair value less cost to sell. But as per Ind AS to inventory, the formula is inventory has to be measured at cost. So if this line would not have been written here, what is the cost for that mango? Nothing. भाई अगर 1000 kg मैंगोज आपने प्लग किए हैं अपने मैंगो गार्डन से, मैंगो ऑर्चर्ड से, तो उसकी कॉस्ट क्या है? उसकी कॉस्ट नेग्लिजिबल है, इमेटेरियल है, राइट? You will say that, sir, we have put a fertilizer, maintenance, so that has gone to the P&L. But I am talking about the 2000 kg, 5000 kg, 1000 kg of mango. So it is immaterial. Because inventory standard talks about inventory has to be measured at cost initially. So that is why it is categorically specified here that the measurement of inventories are not covered here. Measurement of inventories are covered under Ind AS 41, which is fair value less cost to sale. I hope it is clear, Namrata. Guys, I hope the inventory definition is also clear. Let's move on. Some key points. Inventory may include intangible assets that are being produced for resale. For example, software. TCS, Tata Consultancy Services, Microsoft, IBM, Infosys Limited. These companies are selling software. So these softwares are inventory for these companies. Why? Because these softwares are held for sale in the ordinary course of business. Okay. Oracle. For Oracle, SAP, these softwares are inventory. Inventory also includes properties that have been purchased or are being developed for resale in the ordinary course of business. Right? Inventory also includes properties that have been purchased or are being developed for resale in the ordinary course of business. DLF, M3M. So these companies are having a business of buying a properties, develop them and sell them, right? So for these companies, even these are properties, but these properties has to be resale in the ordinary course of business. So it is an inventory for them. Okay. Spare parts, standby and servicing equipment. For example, loose tools, jigs, dies and consumable lubricants are classified as inventory unless they are expected to be used during more than one period or can be used only in connection with an item of PP, in which case they are classified as PP. Friends, you must have audited some factory. I mean to say you must have went to audit for a company which is into manufacturing, right? Normally what happens for these machineries, they used to lubricate these machineries at a frequent time, right? Because there are lubricants, right, which has to be put in the machinery. There are some servicing material, oil, grease, right? So what is these? These are the considered as a loose tools, consumable lubricants, right? Which is used for machinery so that the machinery will run and production will happen. So these are considered as an inventory. There must be some spare part or standby or servicing equipment, right? So if that spare part is getting used frequently, I mean to say, you know that for every month I have to change this spare part in the machinery. It got depreciated or I would say it got eroded. Okay. So जब भी आप उस मशीनरी को यूज करते हो तो पार्ट घिस जाता है. Okay. It got impacted. So you are aware that every month I have to replace this part. So this will be considered as an inventory. But you are installing a part and that part will be used for more than 1 year, then it will be classified as an inventory. Sorry, PP. Is that clear? So inventory may include intangible asset only if it is held for sale. Inventory also include properties only if it is held for sale. Held for sale means held for resale, right? Means in the ordinary course of business. Spare parts, standby and servicing equipment if it is not a PPE. Reusable and returnable packaging or parts. You must have had a cold drink in the glass bottle. Have you ever consumed a cold drink in the glass bottle? Thumbs up. Yeah. Or you must have seen the dealers who are selling these cold drinks, they have a carrot, okay, and the cold drink I have just put in that carrot, okay? And this carrot has to be returned to the manufacturer, right? when everything when everything is completed. Or you must have seen in the shop of the dealer or in the shop of the shopkeeper, there is a fridge, and that fridge is just like a and that fridge is red and white, I would say, and the fridge and the entire Pepsi have been printed on that fridge, right? So they have a different kind of fridge refrigerator which is given by the manufacturer, okay, or distributor. So normally what happens, these got returned to the manufacturer or supplier, or this has to be used for a long period of time. So friends, reusable and returnable packaging materials that are sold to a customer but will be returned to the seller to be reused are not inventory if these items has to be used for more than 1 year. So these will be like a PPE. Is that clear? So the glass bottles are not inventory, right? Why? These glass bottles are returnable to the seller, okay, and these can be reused. So it is not an inventory, because if you will consider that as an inventory, so you can imagine that once you have considered this in inventory, your inventory cost finished goods will be so high, and this material is a reusable and a returnable material, right? Is that clear? Standby equipment means the equipment which has to be kept in the godown or warehouse for any emergency purposes on standby model, like Stephanie in the car. What is that? It is on standby, right? Stephanie in the car. So whenever you got your tire puncture, just you need to replace with the Stephanie. A spare part which has a life less than 12 months is inventory. Yes, you're right. More than one period, is this for 12 months or not defined? So more than one period is not defined, but generally the acceptable parlance is 12 months. Okay. Servicing equipment. So servicing equipment means, see, for example, for any machine you have to service that machine. So you have a small machinery or equipment to service that machine. So it is known as a servicing equipment. Where we show returnable item, so you need to check those returnable items are generally property, plant and equipment, right? For example, the manufacturer had purchased 1000 refrigerators, so these are the property, plant and equipment for them, okay? Or they have purchased, let's say, have you went to Big Bazaar or Reliance Fresh? Have you went to Big Bazaar or Reliance Fresh? Have you seen those trolleys? You are just taking the trolley, put the grocery in that trolley, and then you go to the billing counter. So what is the trolleys? That trolleys are PPE. It is not a inventory. It is a PPE. Right, Namrata? I can see a lot of active participation today. Thank you, guys. Thank you. I believe you are able to understand it very properly. Now come to one of the illustration from ICI study material. As per Ind AS 2, inventories includes material and supplies awaiting use in the production process, right? Material and supplies to be used in the production process. Whether packing material and publicity material are covered by the term material and supplies awaiting use in the production process. So friends, when I talk about material and supplies, so and publicity material, so publicity material is not covered under this particular category. When I'm talking about material and supplies, I'm talking about the primary packing material, right? For example, the tube for toothpaste is a primary packing material. The box outside the tube is a secondary packing material. The polythene for Amul milk, the plastic packing for Amul milk is a primary packing material, which is important, which is necessary for getting this milk into a sellable condition. But if there is another, another packing, special packing, publicity material packing, so that is not a primary packing material. That is a secondary packing material, right? So while the primary packing material may be included within the scope of the term material and supplies awaiting use in the production process, but the secondary packing material and publicity material cannot be so included, as these are the selling costs which are required to be excluded as per Ind AS 2. So I'll discuss which cost needs to be taken, which cost need not to be taken, and these are the selling and distribution cost, right? The secondary packing material. Because even though if you will not put the cardboard, other materials, right, corrugated boxes, still it is in the sellable condition. For this purpose, the primary packing material is one which is essential to bring an item of inventory to its sellable condition, right? For example, bottles, cans, etc. In case of food and beverage industry. For cold drink, that bottle, right, is important. Okay. So this is a primary packing material. But if it is a glass bottle and returnable, then it will not come under inventory, right? Again, you need to check if it is returnable, reusable, and it is expected to be used for more than 1 year, then it is a PP. Otherwise, it may be an inventory. Other packing material required for transporting and forwarding the material will normally be used in the nature of secondary packing material. Is that clear? Is that clear? What if publicity material is essential for selling? So normally publicity material is not essential for selling, right? So when you are talking about publicity material or secondary packing material, it is something else which is there for the purpose of getting it transported, for the purpose of getting it forwarded, right? So the essential means that item cannot be sold without that. Very good. Namrata is saying yes. In cost sheet, we also show that secondary packing material is sales and distribution head. You are right, Namrata. The secondary packing material has to be charged to the P&L in the selling and distribution cost. Very good. Now coming to the measurement of inventories. So we understood what is meant by inventory. We understood the key points of the inventory. We understood what is not included in Ind AS 2, right? And now the time has come how to measure the inventory. Standard says that inventory shall be measured at lower of cost and net realizable value. Lower of cost and net realizable value. Guys, first of all, at the time of initial recognition, inventory has to be measured at cost, right? For the first time, inventory has to be measured at cost. But on the reporting date, on the balance sheet date, inventory has to be measured at cost or NRV, whichever is lower. We will discuss the cost, we will discuss the NRV separately. Now let's discuss the cost part first. Cost includes cost of purchase. Cost of purchase. For example, for manufacturing of car, Tata Motors is purchasing steel, iron, seats, foam, clothes, plastic, engine, gearbox, stereo. What is that? That is cost of purchase. Then cost of conversion. Now, when you are buying these item is not a finished goods. For converting the raw material into the finished goods, into the sellable condition, you need some time, you need some effort, you need some labor, you need some ancillary material as well, right? So that is known as a cost of conversion. Okay, that is known as a cost of conversion. Other cost incurred in bringing the inventories to their present location and condition. Other cost incurred in the bringing the inventories to their present location and condition, right? For example, when you purchase the raw material from China, of course you have to pay some custom duty. You have to pay some, a carriage inward, right? You have to pay some freight. So what is these costs? These costs are part of your inventory cost. Okay. So cost includes cost of purchase, processing cost, and other costs directly relating to the bringing the inventory into the present location and condition. Okay. So friends, first of all, let's talk about the cost of purchase, right? Cost of purchase means purchase cost include the purchase price. Okay. Transport and handling cost, taxes that are not recoverable, and other costs directly attributable to the purchase. A company has purchased an inventory from China. So the price which the company is paying, it is a purchase cost. It is a purchase price, not purchase cost. It is a purchase price. And the company is also paying, in addition to the purchase price, the company is paying a custom duty which is non-refundable. Of course, the company has to capitalize this custom duty as a part of the cost of raw material. The company has to pay the transport cost, the transportation cost from Shanghai port to the Kandla port. Okay. So this freight or transportation cost, handling cost is also going to be capitalized as a part of the cost of inventory, right? In India, the company is required to pay GST, but this GST is a recoverable. The input can be claimed for this GST. In this case, this GST, since it is recoverable, it is not part of the cost of inventory. But what happens if the credit of GST would not be taken? The credit of GST would not be available. In that case, this GST will become the cost of part of your inventory, right? And other cost directly attributable to the purchases. For example, if you have to purchase such kind of a raw material, you have to pay some fees, levies, duties, or you have to pay some brokerage and commission. Without paying brokerage and commission, you cannot purchase that item. Okay. In that case, it is a directly attributable cost to the purchases. Okay. So these cost needs to be capitalized as a part of the cost of inventory. Is that clear? Is that clear? I hope it is clear for all of you. Yeah. So, sir, cost of purchases we have understood. Now the question arises, if we are getting a trade discount or rebates, then what happens? So friends, if you are getting a trade discount or rebates, in that case, this trade discount or rebate has to be deducted from the cost of inventory. Even in Ind AS 16 property, plant and equipment, you have seen that the property, plant and equipment has to be measured at cost, and cost includes purchase price plus directly attributable cost plus non-refundable taxes, right? Minus trade discount and rebates. So if there is a trade discount and rebates, it has to be deducted from the cost of purchase. Is that clear? Sir, if we are buying an inventory and we are paying with a delay, right? For example, the normal credit period was 1 month and we are paying in 3 months. And for that, we are supposed to pay an interest of 2%, right, per month. So when I'm deferring my payment and I'm obliged to pay an interest, in that case, that interest, when payment for inventory is deferred beyond normal credit terms, the arrangement contains a financing element and interest should be imputed if the impact is material. So what does it mean? So when you are paying with a delay in the inventory, when you are paying with a delay for the purchase of inventory, so whatever interest comes out for the payment, it has to be charged to the P&L. It will not become part of your cost of inventory. Is that clear? Is that clear? Likewise in PPE, you remember that property, plant and equipment. Same thing will be there in the PPE. So whenever you are paying, when you are deferring the payment of PPE and paying with a delay, and in that case, you are supposed to pay an interest. So that interest will not form part of your PPE. Interest will go to the P&L. Is that clear? Same way, if inventory is getting paid with a delay and you have to pay an interest, it will go to the P&L. It will not become part of the cost of your inventory. Is that clear? So Mr. G is asking, sir, what if we holding any depreciable asset as inventory and it value depreciating, whether the depreciating value can be charged to the P&L? First of all, let me tell you, the depreciation is only required to be charged on property, plant and equipment, investment property or intangible asset, right? Which is a non-current asset. Inventory by the virtue of its nature is concerned, it is a current asset. Something which is current, you cannot charge depreciation on that. But what happens if the value is getting deteriorated, the value is decreasing, then it is an impairment. And impairment of inventory is there. We will discuss this impairment later on. The last concept of this standard is impairment of inventory, which we will going to which we are going to discuss that, right? But as far as inventory is concerned, it is not going to be depreciated. Okay. For example, DLF, since DLF is classifying these assets, these buildings as a inventory, and DLF is not depreciating inventory. DLF is assessing the impairment of on these inventory. So Namrata, deferred payment means, example, you have to buy a raw material. Let's say you have to buy a limestone for manufacturing cement. Okay. If you are buying a limestone for manufacturing of cement, probably the cash price, when you buy it at a cash price or into a normal credit term, you have to pay 1 crore rupees. But you are paying in 6 months time. You are supposed to pay 1 crore 10 lakh rupees, right? You are supposed to pay 1 crore 10 lakh rupees. Now, like property, plant and equipment, inventory standard says that inventory has to be measured at cash price equivalent. Inventory has to be measured at cash price equivalent. What is the cash price equivalent in this case? The cash price equivalent is 1 crore rupees, but you have paid 1 crore 10 lakh rupees. So why you have paid 10 lakh rupees extra? Because you are getting it financed from the supplier. I mean to say, the normal credit period was 1 month, but you are taking a time of 6 months. So it is just like that you have taken a loan. And that is why the difference between actual payment minus cash price equivalent will be considered as a finance cost, will be considered as an interest cost, and it has to be shown as a interest cost in the P&L separately, right? So that the consistency and the comparability can be maintained. If Viraj is into the same line of business, Namrata is into the same line of business, I am in the same line of business, we all are buying a raw material from one supplier, right? Viraj is paying hard cash. So Viraj will cost the inventory at 1 crore rupees. Namrata is paying with 6 months delay. Namrata will pay 1 crore 10 lakh rupees. I am paying hard cash. I will measure inventory at 1 crore rupees. So if Namrata will measure the inventory at 1 crore 10 lakh rupees, right? So the consistency and comparability is not maintained between these three industries, three companies in the same industry, right? So from the user of the financial statement perspective, the cost of inventory is not 1 crore 10 lakh. Why Namrata was supposed to pay 10 lakh rupees extra? Because she is getting a time for payment, right? And friends, that is why standard says that the price of the inventory is not 1 crore 10 lakh, it is 1 crore only. The 10 lakh additional which you are paying, it is a finance cost, right? It is not your cost of inventory. I hope it is clear, Namrata. Of course, it will affect profit. Of course, yes. Cost of purchase is clear, right? We have discussed the guidance in terms of deferred payment also, and trade discount or rebates also. What is meant by cost of conversion or cost of production? Cost of production or cost of conversion include all direct costs such as labor, material, and direct overheads, right? You understand material, labor, overheads. These are the production costs, right? For producing cars, Maruti is using material. Maruti has employed laborers, and also there are some direct overheads, right? In addition to the material and labor, like energy cost, like water cost, like grease, oil, and other things, right? Direct overheads. And there is a depreciation on the machinery from which the production is happening. There is a maintenance of the factory building. There is a rent of the factory, right? If the factory would not be there, how this production will happen, right? So first, cost of conversion or production includes material, labor, and overheads, right? In addition to this, there is an allocation of fixed and variable production overheads, right? For example, every quantity you will manufacture, you have to pay a 2 rupees of electricity duty, for example. This is a variable production overheads. What is a fixed production overhead? Doesn't matter whatever you produce, you don't produce, you have to pay a factory rent of rupees 2 lakh. You have to pay 2 lakh rupees of factory rent. What is that? That is a fixed overhead. And fixed overhead needs to be absorbed. Variable production overhead is generally fixed per unit, but fixed overhead is generally fixed in the entirety, right? Like rent. Rent is fixed in totality, but variable production overhead is generally fixed per unit. Okay. It will vary in terms of totality, but it is fixed per unit. Is that clear? You understand variable production overhead, you understand variable cost and fixed cost, you must understand that. You are the student of costing also, right? Right? Yes, Rohan. Thanks. The factory rent is a direct overhead. The factory rent, it is a direct overhead. Right? The office rent is not a direct overhead, and that is why it is not form part of the production cost. These includes the depreciation and maintenance of factory buildings and equipment, amortization of intangible assets such as software used in the production process, and the cost of factory management and administration, etc. Labor costs include taxes and employee benefit costs associated with labor, which is involved directly in the production process. So the cost of conversion or production, the fixed overhead, variable overhead, it is only those costs which is directly related to the production. Factory rent, it is important, it is necessary to pay the factory rent so that the production can happen, because the factory rent is directly related to the manufacturing or production. The office rent is not related to the manufacturing or production, right? Now, variable overhead is clear. If there will be a production, there will be a variable overhead. If there will be not be a production, there will be no any cost. But fixed overhead remain fixed, right? Doesn't matter. The production is higher, lower, yes, no, it will fixed. It will be fixed. Now, the question arises, sir, how will we allocate the fixed production overhead? Variable we understand, जितनी यूनिट प्रोड्यूस होगी उसमें हम ऐड कर देंगे. But how to absorb the fixed production overheads? Standard says that the allocation of the fixed production overhead is based on the normal capacity of production facilities. For example, the factory rent is 5 lakh rupees and the normal capacity of production on a monthly basis is 1 lakh unit. So in this case, 5 rupee per unit has to be charged to the cost of the inventory. Is that clear? It says that any inefficiencies should be recognized in profit or loss, classified as other expenses, or if an entity classify expense based on function, allocated to the appropriate function. Just forget about this line. Just remove this line. Okay. What the first line says, any inefficiencies should be recognized in profit or loss, classified as other expenses. For example, due to COVID, the company has paid rent, factory rent, but there were no any production. Should we charge this 5 lakh rupees to the cost of inventory? There is no any production. So answer is no, because it will become an abnormal loss, right? It will become an abnormal loss due to the abnormal situation, right? Otherwise, if everything will remain normal, the normal capacity, the normal production would have been there. Is that clear? The normal production will be there. Is it clear? So any inefficiency should be recognized in profit or loss, classified as other expenses. Friends, please write down. Fixed production overhead has to be recognized as a cost of inventory on the basis of normal production capacity, right? On the basis of normal production capacity. Now, situation number one. If actual production is equal to normal production capacity, then your entire fixed cost will be absorbed. Then your entire fixed cost per unit will be charged to the inventory. Question number 2. If actual production is greater than normal production, If actual production is greater than normal production. I'll continue with the example here. Your 5 lakh rupees factory rent and your normal production capacity is 1 lakh unit. What is the normal per unit cost? The normal per unit absorption cost comes out at 5 rupees per unit. Is that clear? If you are actually producing 1 lakh unit, then of course you have to absorb 5 rupees per unit as a cost of inventory. Now you have produced 1,25,000 unit, or let's say 1,50,000 unit. Your normal production is 1 lakh. Your actual production is 1,50,000 unit. Okay, 1,50,000 unit. So in this case, whether you will charge 5 rupees per unit as a cost of inventory, or you will divide 5 lakh divided by actual production as a cost of inventory. So you will do 5 lakh divided by 1.5 lakh. It will comes out at 3 point something, right? And this will be the cost of inventory. If you will multiply 1.5 lakh by 5 rupee, which is a normal production overhead cost, in that case, it will result in the total absorption of 7.5 lakh, which is not right, because the actual fixed cost is 5 lakh rupees only. Is that clear? So whenever your actual production is equal to normal production, then you have to absorb the cost on the basis of the normal cost, which is 5 per unit in this example. When your actual production is greater than the normal production, in that case, you have to absorb on the basis of total cost, I mean to say fixed cost, divided by the actual production. In this case, cost of inventory will be reduced. So fixed cost divided by actual production, right? Here fixed cost divided by normal production. Third, when your actual production is less than normal production, then what happens? You were supposed to manufacture 1 lakh unit. Due to some inefficiencies, you were only able to manufacture 50,000 units. Now you tell me what should be the cost per unit which is going to be absorbed as a cost of inventory. What is the cost per unit which has to be absorbed as a cost of inventory? And you tell me, if you are doing a production less than normal capacity, is there any inefficiencies? Is there any efficiencies? Yes, when your actual production is less than normal production, it means there are abnormal loss. It means there are inefficiencies. And if there are any inefficiencies, it has to be recognized in profit or loss, right? It has to be recognized in profit or loss, right? So in this case, it has to be absorbed on the basis of normal production. Fixed cost divided by normal production unit will be your per unit cost, which is going to be absorbed. So in this case, 50,000 multiplied by 5, 2.5 lakh has to be capitalized as a cost of inventory. The remaining 2.5 lakh has to be shown as other expenses, abnormal expenses, right? Is that clear? Again, so that your inventory cost will be comparable. Is that clear, friends? So friends, right now what we are discussing, we discussed that inventory has to be measured at cost, right? And then we have discussed what is the concept of cost. What are the inclusions of cost? So we discussed cost includes purchase cost, cost of conversion, and directly attributable cost, right? So when we have discussed cost of purchase, we have discussed purchase price plus transportation or handling cost plus non-refundable taxes minus trade discount and rebates, right? Then we have discussed cost of conversion. What is meant by cost of conversion? Cost of conversion include material, labor, direct overheads plus variable production overheads plus fixed production overheads, right? Variable production is pretty simple. So आप जब भी प्रोडक्शन करेंगे तो पर यूनिट पे उतनी कॉस्ट आएगी. वेरिएबल कॉस्ट तो वेरी करती है ना यूनिट के साथ साथ. But how to allocate the fixed overheads into the cost of inventory? So it says that fixed overhead has to be allocated on the basis of normal capacity, right? If there is any inefficiency, it has to go to the P&L. When inefficiency will arise? When the actual production is lower than the normal production capacity, right? And when your actual production is greater than the normal production capacity, in that case, you have to absorb fixed overhead on the basis of actual production. Otherwise तो आपकी कॉस्ट ही ज्यादा हो जाएगी ना. Is that clear? Is that clear, guys? Okay, let's move on. This is one of the examples from ICI study material. Quickly, we will cover this. Pluto Limited has a plant with the normal capacity to produce 5 lakh unit of a product, and the expected fixed overhead is 15 lakh. So fixed overhead on the basis of normal capacity is 3 per unit. 15 lakh divided by 5. Case 1. Actual production is 5 lakh unit. Fixed overhead on the basis of normal capacity and actual overhead will lead to the same figure of 15 lakh. Therefore, it is advisable to include this on normal capacity, right? Example number 1, which I have taken here. Point number 2, actual production is 375,000 units. Normal capacity is 5 lakh, but actual production is lower than 5 lakh, means there are inefficiencies. Fixed overhead is not going to change with the change in output, and it will remain constant at 15 lakh rupees, right? Doesn't matter, you will produce, you will not produce, you will less produce, fixed cost remain fixed. Therefore, overheads on actual basis is 4 per unit. If you will divide 15 lakh by 3,75,000 rupees, it is 4 per unit. Hence, by valuing inventory at 4 each for fixed overhead, it will be overvalued, and the losses of 3,75,000 will also be included in closing inventory, leading to higher gross profit than actually earned. Therefore, it is advisable whenever the actual production is lower than the normal production, which is point number 3. In that case, you have to charge or capitalize fixed overhead on the basis of normal capacity to actual production. So in this case, 3,75,000 multiplied by 3. 11,25,000 has to be capitalized as a cost of inventory, and 3,75,000 shall be transferred to P&L because this is an inefficiency. Okay, this is inefficiency. Is it clear? Case number 3, where actual production is 7.5 lakh unit, which is more than 5 lakh of normal production. In this case, of course, you have to 15 lakh divided by 7.5 lakh. You have to divide by actual production so that the consistent cost has to be absorbed in the per unit of inventory, right? You cannot go by the normal capacity. I hope it is crystal clear. I hope it is crystal clear. Yeah. Now, friends, what is the exclusion in cost of inventory? What is the exclusion? We discussed cost of conversion, directly attributable cost, like for example, if you are paying some brokerage, commission, professional charges, right, for acquiring the inventory, in that case, it will be considered as a directly attributable cost. Stamp duty, DLF is paying stamp duty on acquisition of land. It is directly attributable cost. DLF is paying advocate charges, court fees for acquisition of land, construction of building. It is a directly attributable cost. Now, what is not included in the cost of inventory? Abnormal amount of wasted material, labor, or other production costs. Example, the labor went on strike, and due to that, there was a loss in the production, right? So it is an abnormal wastage. Or while manufacturing, 50,000 units of inventory got stolen. It is again abnormal wastage. So these kind of wastages, abnormal losses, has to be charged to the P&L directly. It is not part of cost of inventory. Storage cost, unless those costs are necessary in the production process before a further production stage. Warehousing cost, storage cost, it is again not part of cost of inventory until and unless such storage is necessary before the next production stage. For example, wine. So do you know how this wine is going to be manufactured? So the wine has to be stored into a flask or into a cask for a long period of time. In that case, storage cost will be there. Or if I talk about ice cream, if I talk about some perishable item, it has to be stored in a cold place, refrigerator, right? Into a cold storage house. So in that case, it is necessary to keep this item in such a storage condition so that it will remain available for sale, or it will be remain available for use in the production process. So those kind of storage cost has to be capitalized as a cost of inventory, but otherwise all the warehouse cost, storage cost will form part of P&L directly. Administrative overheads. Administrative overheads are also charged to P&L. For example, supervisor expenses, right? Your audit fee, these are the administrative overheads. Selling and distribution cost. Although in the standard only selling cost word has been used, but it includes distribution cost as well. So selling and distribution cost is also going to be charged to P&L. It is excluded, right, from the cost of inventory. Is that clear? Is that clear? Labor wastage means, for example, the labor was sitting idle. Let's say, do you remember in earlier days, or let's say when you go to buy a car, for example, you went to you go to Maruti showroom and you can ask that I want to buy a Maruti Ertiga or Maruti XL6, or you can go to the Hyundai showroom and you can tell them that I want to buy a Creta. They will tell you that they will tell you that there is a waiting of 6 months on Creta. Why waiting for 6 months? Because earlier there is a part in the cars, right? And that part was not available easily. Okay, that part was not available easily. I forgot the name of that part. If you guys can tell me the name of the part of that car. uh, I just forgot the name of the part. It was not available at that point of time, and Vedanta told that we will start manufacturing that part also, right? So what happens, for example, due to non-availability of a part or a material, the labor is sitting idle for, let's say, 15 days, 1 month, because you cannot, you cannot say that to the you cannot tell those laborers that, guys, we are just we are doing a retrenchment for all of you. You cannot say that. You have to engage your labor, right? Otherwise, when the part will be available and production will start, you will not be able to get the labor. So in this case, when the labor is lying idle, in that case, this cost is considered as an abnormal cost and it cannot capitalize as a cost of inventory. It has to be charged to the P&L. Viraj is asking, sir, professional charge related to inventory like stock taking certification, where to include? Viraj, please understand, only those costs needs to be taken into consideration as a cost of inventory, which is important, which is necessary to bring the inventory into the condition or location for sale. Stock taking certification is not important for bringing the inventory into the condition or location for sale. It is just like an audit fee. It is an administrative overhead, right? So professional charges relating to stock taking certification, you're counting stock. It is not adding value to the stock. These are the indirect overheads. These are the indirect cost. It is charged to the P&L, right? It is excluded from the cost of inventory. Per Ind AS 2, selling costs are excluded from the cost of inventory and are required to be recognized as an expense in the period in which these are incurred. Whether the distribution cost would now be included in the cost of inventories under Ind AS 2? Yes. So it is selling and distribution cost. Although the word is selling cost, but it also includes distribution cost, right? Selling and distribution costs are generally used as a single term because both are related. As selling costs are incurred to effect the sale and distribution costs are incurred by the seller to complete a sale transaction by making the goods available to the buyer from the point of sale to the point at which the buyer take the possession. Since these costs are related to bringing, since these costs are not related to bringing the goods to their present location and condition, the same are not included in the cost of inventory. Accordingly, though the word distribution cost is not specifically mentioned in Ind AS 2, these costs would continue to be excluded from the cost of inventories. Moral of the story is selling and distribution cost is excluded from the cost of inventory. For example, if you are doing some specialized packaging for selling that material, so that specialized packaging is not a cost of inventory. It is a selling and distribution overhead. It is a secondary material packing. Is that clear, friends? Let me know if you have any doubts so far. Thank you so much, Namrata, for the feedback. Thank you so much. Glad that you like this session. Is that clear? Yes. Now, guys, let's talk about joint product and byproduct. This is exactly same what we have discussed, what we have learned in AS2 as well. For example, when you're extracting petrol from the crude oil, right? From the crude oil. So although you are extracting petroleum, you are processing for getting this, you are processing the crude for getting the petrol, which is a highly expensive kind of material. But when you are extracting petrol, some processing happens and the diesel also comes out of that. The kerosene also comes out of that, right? So although your intention was to get the petrol, but you are getting diesel as well as you are getting a kerosene. So when you are doing some manufacturing processes, right? Some products emerge. Okay, you are expecting one, but the another product is also coming out. So it is known as a joint product or byproduct. Okay. Thank you, Purvi Ben. Thank you for your feedback. And normally, when you are processing something and instead of one single product, multiple products are coming out, these are known as a joint product or byproduct, right? These are known as joint product and byproduct. So joint product means the product which is having a equivalent value, right? Equivalent value means both are material, like petrol and diesel, both are material. But you are getting an oil which is having a very immaterial value, and it is a byproduct of these products. For example, when you are processing sugar cane, right? When you are processing sugar cane, so you will get the sugar, right? And you will also got a husk, or I say molasses. I would say that the dry part of the sugar cane. Okay, it is also used. It is also used in some industries, right? So friends, but the value is a very limited value, which is a scrap value kind of thing. So this is known as a byproduct. So friends, generally byproduct is kind of a residual product or kind of a scrap value or kind of a product which are having an insignificant value or immaterial value, right? Joint product means the product which are having comparatively a material value. So now the question arises, when you are manufacturing more than one product is coming out, how to measure the cost of inventory for those products? Is that clear? Is that clear? So friends, now we are going to discuss how to do the allocation of cost to the joint products and byproducts, right? So when more than one product is produced in the processes, when you are processing and more than one product is produced, for example, when you are extracting, or when you are, I would say that you are just processing the milk for making it curd, right? So while processing you will get the curd as well as you will get some butter also. Okay, what is that? The curd, or sorry, that lassi is also getting sold out, and the butter is also getting sold out, right? These are two joint products. Okay, or when you are processing milk for making it ghee, right? For making it ghee, one of that and for making a ghee you were just heating the milk, and when you got a ghee is the main product. Ghee is the main product. But after that you got some brown powder types, okay, residual, that is also sold out. Okay, that is also sold out. But that is byproduct. That is not the main product. That is a byproduct. Okay. So now the question arises, when you are processing and out of that process more than one product is coming out, so how to allocate the cost to these products? Or when you are processing that only one product is there and there is a byproduct also, and that byproduct has some value, in that case how to measure the cost of that main product as well as byproduct? So this is what we are going to learn in this particular concept. Is it clear? Is that clear? And first, the outcome is joint product. Means two product or more than two products are emerging out of the production process. When the cost of conversion is separately identifiable, if you are aware that yes, two products are there, but the cost is separately identifiable for product A and product B, then life become very simple. In that case, cost of each product is based on the separate cost incurred. अगर मुझे पता है इन दो प्रोडक्ट्स में से कॉस्ट सेपरेटली आइडेंटिफिएबल है, देन तो देयर इज नो प्रॉब्लम. बट व्हाट हैपेंस when the cost of conversion is not separately identifiable? There is a common cost and the cost is not separately identifiable for these two products. In that case, standard says that allocation of cost is based on the relative sales value of each product, either at the stage in the production process when the product becomes separately identifiable or at the completion of production. It says that, now the crux of the story is, it says that if the cost is common and not separately identifiable, it says that the cost has to be allocated on the basis of proportion of the sales value of these two products. For example, the common cost or the cost of production is 2 lakh rupees. And the sales value of these two products is, for product number 1, 5 lakh rupees, for product number 2, 10 lakh rupees. So in this case, this 2 lakh rupees has to be allocated in the ratio of 5:10, in the ratio of 1:2, right? We will do a case study, we'll do an example illustration from the institute study material, okay, to understand this better. But the concept is, when there are joint product and cost is separately identifiable, no problem. When the cost is not separately identifiable, allocate the cost on the basis of proportion of the sales value of these two products. The outcome is main product with a byproduct, ghee with the residual. So when the byproduct is immaterial, the ghee is getting sold at 600, 700 rupees per kg, and that residual, right, is going to be sold at around 50 rupees per kg or 10 rupees or 20 rupees per kg. So if the byproduct is immaterial, in that case, byproduct is measured at net realizable value, let's say 30 rupees, 40 rupees, and it has to be reduced from the cost of production. So byproduct is measured at fair and net realizable value, and this value is deducted from the cost of the main product, right? But when the byproduct is material, the byproduct is also material. For example, when you are processing petroleum, you got diesel, you got kerosene also. It is also material, right? Kerosene is also having a significant cost. When byproduct is material, in that case, it will be considered as a joint product. right? And then rule number 1 will be applicable. So byproduct is treated as a joint product and accordingly the accounting is going to be done. Is that clear? So friends, if it is a joint product, cost is separately identifiable, then of course that will be the cost for each product. If cost is not significant, if the cost is not separately identifiable, allocate the cost on the basis of proportion of the product values, right? Sales value. If the outcome is main product with a byproduct, in that case, if the byproduct is insignificant like a scrap value, you have to recognize it at net realizable value and reduce that NRV from the cost of the production. Right? If byproduct is material, then it will become a joint product. Is that clear? Let's discuss this and understand this with the help of illustration number 4 of ICI study material. Viraj is asking, sir, how to classify byproduct is material or immaterial. Viraj, it is on the basis of cost, right? Generally, Viraj, byproducts are like a residual, right? Husk, molasses, these are the byproducts where the value is very insignificant. It is like a scrap value. But if it is a main product or if it is I would say a very usable product, the value is significantly higher. In a manufacturing process of Mars Limited, one byproduct, BP is a byproduct, emerges besides two main product MP1 and MP2 apart from the scrap. Detail of cost of production process are here under. Very good illustration. In this illustration, two main product are there. I mean to say two joint product are there. MP1 and MP2 and one byproduct is there. So there is joint product. MP1 and MP2. There is one byproduct which is BP. And the items are given. Raw material is 14,500 unit. The cost is 1,50,000. There are wages given to laborers, 90,000 rupees. Fixed overhead is 65,000 rupees. Variable overhead is 50,000 rupees. And now the output is main product, which is joint product, is 5,000 units. And the value of the closing stock is 250. And MP2 is 4,000 unit. Value of the closing stock is 100 rupees per unit. Byproduct is 2,000 units. Okay. And the value is not given. Average market price of MP1 and MP2 is 60 rupees per unit and 50 rupees per unit respectively. Average market price is 60 rupees per unit and 50 rupees per unit, right? So average market price is 60 rupees per unit and 50 rupees per unit. Okay. 60 rupees per unit and 50 rupees per unit. And byproduct is sold at 20 rupees per unit. There is a profit of rupees 5,000 on sale of a byproduct after incurring separate processing charges of rupees 8,000 and packing charges of 2,000, right? Rupees 5,000 was realized from the sale of scrap. There is a profit of rupees 5,000 on sale of byproduct after incurring separate processing charges of 8,000 and packaging charges of 2,000. Means you have incurred a cost of 8,000 on processing, 2,000 on packing, 10,000 is the total cost, and you got a profit of 5,000. Means the byproduct have been sold at 15,000 rupees, right? And 5,000 rupees was realized from scrap also. So there is a scrap also in it is written na. There were 4 items, 2 main product, a byproduct and a scrap. So 5,000 rupees has been realized from scrap also. So there are 4 items. Scrap is also there, which is in addition to byproduct. Calculate the value of closing stock of MP1 and MP2 on 30. And the NRV of scrap is also given. So first of all, let's discuss the NRV of byproduct. What is the NRV of byproduct? What is the NRV, net realizable value of the byproduct? So selling price of byproduct is 2,000. The total byproduct is 2,000 unit. What is the selling price? 20 rupees per unit. Byproduct is sold at 20 rupees per unit, right? Is sold at 20 rupees per unit. So 2000 multiplied by 20, it comes out at 40,000. What is the separate processing charges? 8,000 rupees is separate processing charges. Packing charges 2,000 rupees. It means, what is the formula of net realizable value? The formula of net realizable value is estimated selling price minus estimated cost of completion, right? So as per Ind AS 2, most byproduct as well as scrap are or waste material by their nature are immaterial. They are often measured at NRV, and this value is deducted from the cost of main product. So friends, we need to compute the NRV of the byproduct and value of the scrap to reduce from the cost of production, because the final cost of production has to be allocated to the main product, right? So what is the NRV? Net realizable value is estimated selling price. What is my estimated selling price? 2000 unit multiplied by 20 rupees per unit. Okay. And what is my NRV? 40,000 minus 10,000 is my NRV. Is that clear? Is that clear? I hope net realizable value is clear. Okay. Now friends, what is the cost of production? Now you need to compute the cost of production. My cost of production is 1,50,000, 90,000, 50,000, 65,000. Okay. 150, 90, 65, 50. This is my cost of production. Whatever net realizable value is there for byproduct, you need to reduce that. And whatever sales value of scrap is there, you need to reduce that. So total value is 35,000. So your total joint cost, total cost of production is 3,20,000, right? That is what we have learned. Byproduct is measured at net realizable value, and this value is deducted from the cost of the main product, right? Generally, byproduct or scrap is considered as immaterial from the perspective of Ind AS 2, okay? And the NRV has to be deducted from the cost of the main product. And after that, you need to allocate this cost of the product, this cost of production into the joint product. Are you clear so far? Are you clear on this so far? Are you clear so far? Guys, are you able to hear me properly? One of the student is saying he is facing some issue, but my internet connection is running fine. I can say that. Okay. Others are saying that yes, internet connection is running fine. Viraj, I think you need to check your internet connection. Yes. So guys, the first step is, your first step is calculate the NRV of byproduct, calculate the NRV of or sales value of the scrap. First step, please write down, calculate the NRV of byproduct, which is estimated selling price minus estimated cost of completion. Then calculate the value of the scrap, which is 5,000 in this case. Then calculate the cost of production, right? Cost of production, which is total cost minus NRV of byproduct minus sale value of scrap. Okay. Now you need to allocate this 3,20,000 into the sales value of main product. What is the sales value? The units are 5,000 units and 4,000 units, right? 5,000 unit, 4,000 unit. The selling price is 60, 50. And what is the sales value? The sales value is 3 lakh for MP1 and 2 lakh for MP2. So what is the ratio? 3:2 is the ratio. Now you need to allocate 3,20,000 in the ratio of 3:2. So 3,20,000 multiply by 3 divided by 5. It will give you 1,92,000. 3,20,000 multiply by 2 divided by 5. It will give you 1,28,000. So now what is your cost per unit? Your cost per unit will comes out at 38.4. 1,92,000 divided by 5,000, right? 1,92,000 divided by 5,000 and 1,28,000 divided by 4,000. It will comes out at 32. This is your cost per unit. Now you need to determine the value of closing stock. What is the ask of the question? Value of closing stock. What is the value of closing stock? What is the closing stock per unit? The closing stock is 250 and 100 unit. The closing stock is 250 and 100 units. This closing stock is units. In it should be mentioned in the question, right? It is units. 250 unit, 100 unit. Now what is the cost? 38.4, 32. So value of closing stock is 9600 and 3200. It is the value of the closing stock. Is that clear? Friends, please tell me if you found any difficulty in understanding the concept of joint product and byproduct, how to allocate the cost into the joint products, right? Number one step, first step, compute the net realizable value of byproduct. Number two, calculate the value of the scrap, if any. Number three, compute the net cost for allocation, net production cost for allocation into the joint product, which is total cost minus NRV of byproduct minus sales value of scrap. Number four, allocate the cost between the joint production, between the joint product on in the proportion of their sales value, right? Then you will get the cost per unit of the joint products, right? And how to compute cost per unit? Allocated cost divided by unit produced, okay? And then you have to value it at the closing value. Closing units multiply by the cost. Is that clear? Very good. So Purvi Ben is saying it is clear very smoothly. Thanks Radhika for such a wonderful feedback. Thank you so much. Glad that you guys have liked it. Before starting a new concept, let's have a 5 minutes break. It's 8:28 now, and we will start at 8:33. Okay. Students, so far we have understood that inventory has to be measured at cost or NRV, whichever is lower. If I'm talking about cost or NRV, so it is at the subsequent date, which is reporting date. But normally inventory has to be measured at cost, and we understood the meaning of cost, right? We discussed so many cost guidance, like what is meant by cost, purchase cost, cost of conversion plus directly attributable cost. Then we have discussed what is not included in the cost of inventory, right? Like abnormal cost, abnormal wastage, your storage cost, which is not necessary, then your administration overheads, and your, apart from administration overhead, selling and distribution cost, right? Then we discussed about deferred payment terms. If there is a deferred payment terms and you are paying extra, it will be considered as a finance cost, right? Then we discussed the concept of fixed production overhead and variable production overheads. So variable production overhead varies with the unit. There is no any problem. But in case of fixed production overhead, normally it has to be absorbed to the inventory cost, capitalized to the inventory cost per unit on the basis of normal capacity. If actual production is equal to normal capacity, it is okay. If actual production is more than the normal capacity, your fixed production has to be divided by the actual production to give a correct absorption per unit, uh, on the quantity actually produced. But if the actual production is less than the normal production, means there are inefficiencies, there are abnormal wastage. So in this case, the absorption to the unit produced is on the basis of normal production, like, right? And the remaining amount has to charge to the P&L as other expenses. Then we discussed joint product and byproduct. If there are joint products, of course, joint products are the main product. You need to allocate the cost to these products separately. If the cost is separately identifiable, then life becomes simple. If cost is not separately identifiable, then you need to allocate the cost on the basis of their sales values, right? And if there is a byproduct, so normally byproduct is considered as immaterial, and byproduct has to be measured at net realizable value, and its NRV has to be reduced from the cost of production. If there is a scrap has to be recognized at sales value, and its sales value has to be reduced from the cost of production. Now, whatever is the cost of production net, it has to be allocated in the ratio of sales value of the main products, joint products, right? And this is how the cost will be arrived on the basis of joint products. Now we are going to discuss about the cost formulas, right? So far we have discussed the cost component. Now we are discussing cost formulas. What is meant by cost formulas, right? So, so friends, if I talk about an inventory where specific identification is there. Let's say Maruti. Maruti is selling cars in a lot of quantities, right? In a large quantity. When you go to the Maruti plant and you will see Maruti Swift car, you will find hundreds of Maruti Swift car was standing in the yards. Okay. So when you want to buy that car, they will just pick one car and they will sell you. But when you go to the showroom of Dilip Chhabadiya, DC, who is into modified cars, sports cars, every car is a specific identified car. Every car is with a specific identification, right? So all the cars are not looking similar. Every car is a different car. So friends, standard says that if there is a specific identification of the inventory, in that case, you have to absorb the cost of that inventory. You have to allocate the cost manufactured for that inventory, and that inventory has to be measured at its identified cost only. But there is no specific identification. Then, for example, again in the example of Maruti cars, there are 100 of Swift car, right? In that case, how the remaining car which is lying in the stock, so at what value these cars are going to be measured? I mean to say, what is the formula on the basis of which the value of the car has to be derived? So if there is no specific identification, either you have to take it on a FIFO basis or on the basis of weighted average cost formula. And let me give you an example to make you understand this. For example, Dilip Chhabadiya. he has an opening inventory of cars. Opening inventory of car. There is a car one, which is like a Tarzan car. It is modified like a Tarzan car. Car two, it is modified like a Superman car, right? Car three, it is modified like a, I would say, like a missile car. These all are the these all are having a specific identification. These are different, right? Now what happened? These were the opening inventory, and they have purchased some cars during the year also. During the year, they have purchased some cars. Car 4, car 5, car 6, right? Having a different specification. Like this is a Hulk car. This is like a Bruce Lee car. I'm just giving a name to the cars. This is like a Mugembo car. Friends, at the end of the year closing stock, they have sold out car number 1, car number 3, and car number 5. Only car 2, 4, and 6 is lying in the stock. So what you will do? You will measure the car number 2, 4, and 6 on the basis of its actual cost. Am I right? Am I right? Now what happened? Why you were able to measure these cars on the basis of their specific cost? Because these are the specifically identified, okay, cars. But if I take an example of Maruti has a, and I'm taking an example of WagonR या फिर Swift car. Maruti has a opening inventory of, let's say, 100 cars. Maruti manufactured or produced during the year. During the year, Maruti manufactured or produced 150 cars. Closing stock, they are having for 80 cars. Now, these are the same cars. These are the interchangeable cars. Okay. So they have an opening inventory of 100 cars. For example, out of that opening inventory, this was costing, let's say, 1 lakh rupees per car. Means 100 into 1 lakh, 1 crore rupees. The total value of the opening stock was 1 crore. The car was 100. During the year, 150 car were produced with a cost of, let's say, 3 crore rupees. Right? So now only 80 car is lying in the stock. So 250 minus 80, 170 car has been sold out. Now at what value this 80 car should be measured? Whether you should take it is a part of 150 car or it is a part of 100 car, because the cost of 100 car, the value of 100 car was 1 crore, means 1 lakh rupees per car. And the production cost of 150 car is 3 crore rupees, which is 2 lakh rupees per car. So what should be the value of this 80 car? Whether it should be 80 multiplied by 2 lakh or 80 multiplied by 1 lakh or partly. So friend, standard says that if there is no specific identification and the inventories are similar and interchangeable inventory, either you have to apply FIFO method. FIFO means first in, first out. It means if 80 car is lying in the stock, it means 170 car have been sold out in totality, right? So 170 car has to be sold out on the basis of FIFO basis. First in, first out. Means out of 170, this entire 100 car has been sold out. The remaining 70 has been sold out from the production during the year. It means this 80 car belongs to this stock, this cost. So means 80 car has to be valued on the basis of 2 lakh rupees per unit. Is that clear? The first one is FIFO method. The second one is the second one is weighted average formula. What is the weighted average formula? What is meant by weighted average? If 100 car is costing 1 crore, 150 car is costing how much? 3 crore. So what is the total cost of the car? 4 crore. What is the total quantity? 250. 4 crore divided by 250. How much it will comes out? How much it will comes out? 4 crore divided by 250. Let me calculate this on my calculator. 4 crore divided by 250. it comes out at 1,60,000. 1,60,000. So going by the weighted average cost formula, you have to measure closing stock 80 multiplied by 1.60. Going by the FIFO, you have to measure closing stock 80 multiplied by 2 lakh. Is that clear to all of you? Is that clear to all of you? Yeah. It is the same formula which we have learned, understood, applied, discussed in AS2. LIFO, last in, first out. Sir, can we say that out of 170 cars which have been sold out, so 150 so this out of this 170 entire 150 which have been produced during the year, manufactured during the year, that has been sold out. Answer is no. LIFO is not permitted under Ind AS, AS or IFRS. LIFO is not permitted. So this is the cost formula. If it is specifically identified, you have to go by the specific cost method. If it is no specifically identified, you have to go by the FIFO or weighted average. An entity shall use the same cost formula for all inventories having a similar nature and use to the entity. For example, the entity is into three kind of business. One, selling of cars. Second, for example, selling of two-wheelers, four-wheelers, two-wheelers, and the third one is, let's say, selling of stereo, right? Selling of stereo. So for cars, the entity has to either apply FIFO or weighted average. So whatever it has to apply the same formula for all inventories having a similar nature and use to the entity. For car, they can apply cost formula. For two-wheeler, they can apply weighted average formula. For stereo, they can apply FIFO formula, right? So whatever formula they need to apply the same formula for all the similar nature of inventory. For example, they are manufacturing two type of car. Commercial vehicle, I mean to say commercial vehicle means like the vehicle for the business purposes, and the private vehicle. So although the nature is similar, doesn't matter, one is commercial and one is private, but it is a similar class of similar nature of production is happening, right? Item is getting produced. So if you are applying FIFO method for private vehicle, you have to apply FIFO method to commercial vehicle as. For inventory with a different nature or use, different cost formula may be justified. For example, four-wheeler, two-wheeler, stereo. So these are the different inventory. So you can apply different cost formula. So you can apply FIFO, weighted average for anyone. Yeah, is that clear? Namrita, similar nature I have explained you. Guys, inventory valuation technique. Okay. So now coming to inventory valuation technique. Inventory ordinarily interchangeable means like cars. There are a lot of cars which are lying in the stockyard of the company. So every car is similar, right? Every car is similar. So if it is ordinarily interchangeable, you have to apply historical cost method. What is historical cost method? FIFO or weighted average, right? Inventory is ordinarily interchangeable. This is the historical. Then you can also apply non-historical cost method. For example, in grocery store, in departmental store, do you know how they are valuing the inventory? For example, they have shampoos. They have 100 bottle of shampoos, and they know that the retail selling price of shampoos are 500 rupees, right? So what they will do? They will value the shampoos, inventory of shampoos on the basis of selling price minus profit margin. They know that whatever we sold, we used to have a profit margin of 20%. So for retail inventories, for the retailers, what they can do, they can measure their inventory on the basis of sale price minus profit margin. So for them, sale price minus profit margin is equal to closing stock, is equal to cost. So retail inventory or adjusted selling price method. It is used when large number of rapidly changing items with similar margin are involved, right? For example, Maggi. if the shopkeeper has 100 packets of Maggie, so the first packet cannot differ from the second packet, right? So how these shopkeepers or retailers can measure the inventory? What they can do, they can just say 100 packet multiply by 12 minus 20% of profit margin. So 100 multiplied by 10, right? Cost is determined by reducing the sales value of the inventory by the appropriate percentage gross profit margin, right? Standard cost method. It takes into account normal levels of material supply, labor, and capacity utilization and are reviewed regularly. What is meant by standard costing? You guys are costing students also. You know standard costing. You are aware that normally what happens if I have to produce, let's say how these electronics companies are doing. Let's say Samsung is manufacturing a mobile phone of Galaxy 9, right? So when they are manufacturing a mobile phone, they know that my standard costing for this configuration of mobile phone or handset is, let's say, 40,000 rupees. So that is their standard cost, right? So even this standard cost is also allowed as a cost formula, right? Standard cost is also allowed. Is that clear? But in this case, this standard cost has to be reviewed regularly, right? Is that clear, guys? So if inventory is ordinarily interchangeable, means similar nature of inventories are there into a large quantity, either you can apply historical cost formula method, which is FIFO or weighted average method, or you can apply non-historical cost method. For example, departmental store retailers, what they are doing, they are applying sale price minus profit margin for calculating the cost. Is that clear? So here, when I'm talking about cost formula, we are talking about measurement of closing stock. At what formula you will apply for measuring the closing stock. What we have learned in the cost component, that is for the initial recognition of the valuation of inventory. Is that clear? Remember, let's say if I have taken an example of this 150 car have been sold at 3 crore, sorry, 150 car has been manufactured at a cost of 3 crore rupees. What is that? That is your cost component. वो 3 करोड़ कहां से आए? Cost of purchase plus cost of conversion, fixed overhead, production overhead, by product, main product, scrap, वो सब वहां से आया. Now on the closing, I am measuring my valuation of stock. In that case, either you can go by the specific identification. If it is not ordinarily interchangeable, then you have to go by the specific identification. If it is ordinarily interchangeable, you can change, you can replace one item with another. In that case, historical cost method or non-historical cost method. There are total 4, which is FIFO, weighted average method, retail sale price method, and your standard cost method. I hope it is clear to all of you, friends. Yeah. Valuation and measurement is the same thing. Whereas standard costing means estimated cost, budgeted cost. You are aware that if I have to manufacture a particular Maruti car, so the configuration of car includes such kind of material, such efforts of labor, and such amount of variable cost and fixed overheads everyone is aware of. So the standard costing per unit is, let's say, 5 lakh rupees. So either it can be measured at standard costing, but standard cost is only standard cost will be used only in such kind of setup where the costing mechanism are very strong and the standard cost are getting reviewed on a regular basis, right? Why LIFO prohibited? Because you tell me, if you are a shopkeeper or you are a manufacturer or a trader, which item you will sell first? The item which were lying in the godown in the beginning, you will sell that item first or you will sell the latest item first? What is your interest? And I can tell you a classic example here. You know, there is a departmental store and you know, we are consuming atta bread, flour bread, right? When I went to buy the bread from the departmental store, you know what they do? Every day they are getting a fresh breads, right? But they keep the older bread in the front. For example, today is 30th May. When I go to buy the bread, there is a 30th May printed breads are also there, fresh breads. But what they will do? In the front, they will keep 29th May or 28th May bread. Old item they will keep in the front so that it will be sold out fast, right? So this was the logic, right? Is that clear? Friend, let's discuss the illustration on the cost formula from the Institute study material. Mars Fashion is a new luxury retail company located in a Lajpat Nagar, New Delhi. Kindly advise the accountant of the company on the necessary accounting treatment for the following item. One of the company's product line is beauty products, particularly cosmetics such as lipstick, moisturizers, and compact makeup kits. The company sells hundreds of different brands of these products. Each product is quite similar. Like they are selling Lakme, they are saying selling other products, Nika, okay. But lipstick is lipstick, be it Nika, be it Lakme, okay. Each product is quite similar, is purchased at similar prices. The prices are also similar and has a short life cycle before a new similar product is introduced. The point of sale and inventory system is not yet fully functioning in this department. So you cannot measure inventory on a line item basis, on every quantity basis, right? That is not so foolproof. It is like a departmental store. The sales manager of the cosmetic department is unsure of the cost of each product, but is confident of the selling price. The sales manager knows that whatever lipstick is lying in this batch, I'll sell every lipstick at 1000 rupees. And you also know that on an average, the company makes a gross profit of 65%. So guys, what could be the appropriate method for this kind of interchangeable inventory? This is a case of large quantity of inventory, which is ordinarily interchangeable also, right? FIFO, for FIFO, you need to be aware about what was my opening inventory, quantity and cost. Then during the year, purchased quantity and cost, but this is not there in this department. The cost may be there, but the accounting system is not very strong. Weighted average, again, you need to have a quantity wise cost. Standard cost is not applicable because this is kind of a retailer. So which method is most appropriate? Which method is most appropriate? In this case, the retail method can be used for measuring inventories and for beauty products. The cost of inventory is determined by taking the sales price of the cosmetic and reducing it by the gross margin of 65% to avoid the to arrive at the cost. Retail sale price method is the most appropriate method. Are you all agree with me? Second, Mars Fashion also sells handbags. They are also sells handbags, and the company manufacture the handbags at their own, as they wish to be assured of the quality and craftsmanship which goes into each handbag. The handbags are manufactured in India in the head office factory, which has made handbags for the last 50 years. Normally, Mars manufacture 1 lakh handbags a year in their handbag division, which uses 15% of the space and overhead of the head office factory. The division employs 10 people and is seen as being an efficient division within the overall company. See, they are into this business since last 50 years and they are delivering quality. And every year they are normally manufacturing 1 lakh handbags. And they are occupying a space of 15% of this entire factory. And they are also sure about the overheads which is getting deployed in this handbag manufacturing. And they employ 10 people. And it is a very efficient division. No inefficiencies are there, nothing like that. So in this case of setup where they are manufacturing, am I audible now? There was a technical glitch. I hope I am audible now. Am I audible now? Okay, thanks. Yeah, so coming to this point number B, what is the most appropriate method? Standard cost could be the most appropriate method because they are aware about the costing as well. Standard cost, right, is the most appropriate method. Is that clear? Is that clear, friends? Standard cost is the most appropriate method, right? In this case, the handback can be measured using standard cost, especially if the result approximate to the cost. Given that the company has the information reliably on hand in relation to direct material, direct labor, direct expenses, and overheads, it would be the best method to use to arrive to the cost of the inventories, right? Okay. So friends, let's quickly do this case study, illustration number 7 from the ICI study material to understand the cost formula. Mercury Limited using a periodic inventory system. The following information relates to 2001-2002. What is that? The date, particulars, unit, cost per unit, and total cost. In April month, the opening inventory was 200 unit, 10 rupees cost per unit, 2000 rupees is the total cost. In May, they have purchased an inventory of 50 rupees. Sorry, they have purchased the inventory of 50 unit. The cost is 11 rupees per unit and the total cost is 550. In September, they have purchased 400 units, 12 rupees per unit cost, and the total cost is 4800. In February, they have purchased 350 unit, total cost is 14 per unit, 4900 is the total cost. In total, they have 1000 units and the total cost is 12,250. Physical inventory lying in the godown is 400 units. Means how much unit have been sold out? 600 units. Calculate closing inventory value and cost of sales using FIFO and using weighted average. So guys, if I'll use first in, first out, in that case, if I'll use first in, first out of 600 inventory, 200 will be from this lot, 50 from this lot, 250, and the remaining 350. So this 250, 200 has gone, 50 has gone, and remaining 350 from this lot. So the closing inventory will be 350 multiplied by 14, 4900 plus 50 multiplied by 12, 600. So 5500 is the value of the closing inventory going by the FIFO method. If I need to apply weighted average method in that case, if the total cost is 12,250 and the total unit is 1000, what is my weighted average cost? 12.25 is my weighted average cost. So 12.25 multiplied by 400 unit will be the closing stock value. Is that clear? In this case, going by the FIFO, what is my inventory on 31st March 2002? 350 multiplied by 14 and 50 multiplied by 12, right? 500. And what is my cost of sales? My cost of sales is total cost 12,250. Value of closing stock is 5,500 in the FIFO. So the remaining is your cost of sales. Weighted average cost is 12.25. Closing inventory is 4,900. So 400 multiplied by 12.25. Okay. 400 multiplied by 12.25 straight away. 900. And your cost of sales is 12,250 is the total cost. So 12,250, 12, 250 minus 4,900. So 7,350 is your value of cost of sales. Is that clear? This is what I have already explained. Now let's come to the net realizable value. On the subsequent measurement, I mean to say on the reporting date, you have to arrive at a cost. Then you have to arrive at net realizable value also, because inventory has to be remeasured at cost or NRV, whichever is lower. What is meant by net realizable value? Net realizable value is estimated selling price minus estimated cost of completion minus estimated selling cost. It will give you a net realizable value. For example, Maruti Suzuki India Limited has 100 cars lying in the stockyard, and the cost of car is 5 lakh rupees. From the 1st April, the price of the car is going to be increased by 5,50,000 rupees. So whatever car will be sold out effective from the 1st April, it will be sold out at 5,50,000 rupees. So friends, now if the closing stock is lying in the godown on 31st March, this has to be sold from the 1st April, right? अगर 31 मार्च को कोई बैलेंस शीट में इन्वेंट्री है तो वो तो अगले दिन ही बिकेगी ना. But if you need to apply the cost formulas, when you arrive at a cost, once you have recognized at a cost, then you are valuing this inventory at a closing stock, this closing stock at a cost, right? Either FIFO, either weighted average, either retail sale price, or either standard cost. You will arrive at a cost. The cost is on the basis of the past. But when you are calculating net realizable value, first you need to see what is my estimated selling price. And estimated selling price is not price effective 31st March. The price which will come, the price which will be arrived, the price which will be arrived from 1st April. The price which will be arrived from 1st April. So 5,50,000. Estimated selling price will come as a 5,50,000 minus, if you need to spend any money on the completion, you have to reduce that. If you want to spend any money on selling cost, you have to reduce that. It will give you net realizable value, right? Estimated selling price minus estimated cost of completion minus selling cost will give you an NRV. This NRV is a entity specific value. This NRV is not a market value. It's a entity specific value, right? For example, Samsung, it is selling a same configuration of phone at 50,000 rupees due to the brand value. If I talk about Redmi, Xiaomi, right? If I talk about Redmi, so for the same configuration or the better configuration, they are selling at 25,000 rupees. So what is NRV for Redmi? It is 25,000 rupees. What is NRV for Samsung? It is 50,000 rupees. So NRV is a entity specific value, right? Now, friends, I have told you three kind of inventory, right? Finished goods, work in progress, raw material. Material and other supplies held for use in the product of inventory. When finished goods are sold at or above cost, raw material is measured at cost. When finished goods are sold at NRV, raw material is measured at replacement cost. Okay, it is meant by this. Friend, finished goods is measured at cost or NRV, whichever is lower. Whichever is lower. Work in progress is measured at cost or NRV, whichever is lower. Sir, for work in progress, how can we calculate net realizable value? For example, you have done 80% stage of the production. Then how to compute the net realizable value? If this process would be completed, how much cost will be required? For example, 100 rupees will be required. And at how much price it will be sold out? It will be sold out at 200 rupees. Means estimated selling price is 200 minus cost of completion is, let's say, 50 rupees, not 150 rupees. So it means 150 rupees is NRV till the time it is produced. Have you understood that? So हम कैसे कैलकुलेट करेंगे WIP का NRV? WIP तो बिक नहीं सकता. हम कैलकुलेट करेंगे by backward calculation. कि first of all, how much effort, how much money, how much costing is required to complete this. For example, 50 rupees. After completion, what is the estimated selling price? 200 rupees. So 200 minus 50. So 150 is the estimated selling price, NRV, for the work in progress. What about raw material? Raw material has to be measured at cost. It is not measured at cost or NRV. It is measured at cost. But if the raw material which is getting used in the finished products, finished goods, if the finished goods is measured, if the finished goods is sold at below cost, अगर जो फिनिश गुड से वही सस्ता बिक रहा है, वो कॉस्ट से कम पे बिक रहा है, तो आप रॉ मटेरियल को भी रिप्लेसमेंट कॉस्ट पे वैल्यू करोगे. इज दैट क्लियर? इफ द फिनिश गुड्स इज सोल्ड एट कॉस्ट और अबव कॉस्ट, तब रॉ मटेरियल को आप कॉस्ट पे रखोगे. सर अगर फिनिश गुड्स सस्ता बिक रहा है, फिनिश गुड्स इज गेटिंग सोल्ड एट बिलो कॉस्ट, तो मैं इसको रॉ मटेरियल को रिप्लेसमेंट कॉस्ट पे क्यों लेके आऊंगा? इसका मतलब नुकसान है. आपकी जो रॉ मटेरियल है उतना भी आप रिकवर नहीं कर पा रहे फिनिश गुड्स को बेचने के बाद. इट इज इनएफिशिएंसी. दैट इज व्हाई द रॉ मटेरियल हैज टू बी मेजर्ड एट रिप्लेसमेंट कॉस्ट. मींस Replacement cost means NRV. Okay. What is the net realizable? What is the scrap value of this raw material? Is that clear? So please write down this. If finished goods are measured at cost or NRV, whichever is lower. Work in progress is measured at cost or NRV, whichever is lower. But raw material has to be measured at cost. But if finished goods, is sold below cost, in that case, raw material has to be measured at NRV, which is replacement cost. Yes, Namrata, it is prudence concept. I must say that the participants of this batch are very interactive and very learned participants. I must say that you guys have a very bright future ahead. Now, someone was telling about depreciation on inventory. So, guys, there is no depreciation, but there is an impairment on inventory. There is an impairment on inventory, right? What is meant by impairment? For example, the cost is, let's say, sorry, the cost is, let's say, 1 lakh rupees. And this COVID hit us in March 2020. So the closing stock NRV, net realizable value, has gone down to 80,000 rupees because this NRV is depending on the estimated selling price minus cost of completion minus selling cost, right? This become 80,000 rupees. So you have to recognize, you have to remeasure this inventory at cost or market value, whichever is lower. So in that case, what happens? You have to reduce the value of the inventory, which is below cost. So you have to impair the inventory by 20,000 rupees. And what is that? Impairment loss account debit to inventory account 20,000. Now in the next year, when the market has opened, the COVID has settled down, the vaccination was there, again the value of the inventory has gone up. It become 1,10,000. So standard says that if the situation is better and the indicator of reversal is there, you can reverse the impairment, but you can only reverse the impairment to the extent impairment booked earlier. अगर आपने 20,000 रुपए का impairment record किया था, तो only to the extent of 20,000 you can reverse the impairment loss whenever there is an increase in the value of the inventory. Why? Because even earlier, if cost was 1 lakh and NRV was 1,10,000, at what value you're recording the inventory? Cost or NRV, whichever is lower. Right? So going by the prudence concept, you are recognizing your asset at lower, right? So that is why if nowadays NRV become 1,10,000, you cannot go beyond 1 lakh, beyond cost. Okay. So this cost or NRV, whichever is lower, due to the reduction in the value of NRV, there will be an impairment. And if the situation will become better, so that there will be a reversal of impairment, and this reversal of impairment has to be shown as a this reversal of impairment has to be recorded to the extent of earlier impairment recorded. Let's discuss this illustration. UA Limited purchased raw material at 400 rupees per kg. Company does not sell raw material but uses in production of finished goods, right? So they have purchased a raw material at 400 per kg, but company raw material sell नहीं करती, इसको finished goods में use करती है. The finished goods in which raw material used are expected to be sold at below cost. Means the finished goods are getting sold at below 400. At the end of the accounting year, company is having 10,000 kgs of raw material in the inventory. There is 10,000 kg of raw material. As the company never sells the raw material, it does not know the selling price of raw material and hence cannot calculate the realizable value of the raw material for valuation of inventory. However, replacement cost of raw material is 300 per kg. So the current cost of the raw material, if the company go to the market today, because the finished goods price has gone down, in this case, the price of the raw material has also gone down. So if the company will replace the material today, the company will get this material at 300 rupees. So what is the replacement cost? This is 300 rupees. So in this case, this material is going to be recorded at 10,000 multiplied by 300. And 100 rupees per kg will be recorded as an impairment loss. Any doubt? Any doubt, friends? Yes, Mr. G, it was impairment, not depreciation. Now coming to the last part, not relevant from the examination perspective, disclosures. Like every asset liability related standards are having disclosure, every standard are having disclosure. So the accounting policy adopted in measuring inventory is required to be disclosed. Cost formula, FIFO, weighted average, retail sale price, standard cost is required to be disclosed. Carrying value of the inventory is required to be disclosed. Carrying value of inventory carried at fair value less cost to sell is required to be disclosed. For example, biological asset inventory. Amount of inventory recognized as an expense during the period is required to be disclosed. For example, impairment. Okay. So these are the disclosure requirement. And this is your favorite slide. Thank you so much, friend. If you have any question, I would be happy to answer. And so far, I have completed this Ind AS 2 completely with so many examples, practical illustrations from ICI study material, right? And since beginning, I have started with the objective and scope. Then I've told you that inventory are the raw material, finished goods, and work in progress, which are held for sale in the ordinary course of business, held for use in the production or such sale, or it is material or supplies which has to be used in such production processes, right? Then we have discussed about the that what is considered in the inventory, finished goods, work in progress, raw material, spare parts, standby servicing equipment, if it is not PPE, right? Loose tools, jigs and dies, okay? Primary packing material, it is considered as an inventory. Inventory has to be measured at cost or NRV, which inventory has to be measured at cost at the time of initial recognition and has to be measured at cost or NRV, whichever is lower on the balance sheet date. Then we have discussed cost means cost of purchase plus cost of conversion plus directly attributable cost. Then we discussed cost of purchase means purchase price plus non-refundable taxes plus directly attributable cost, which is your transportation cost, handling cost, minus trade discount and rebates, right? Then we discussed the concept of deferred payment. If you are deferring and you are paying extra, it will be your finance cost debited to the P&L. Then we discussed cost of conversion where material, labor and overheads were there. Then we discussed how to absorb, how to allocate fixed to production overhead. And we discussed three scenarios, and fixed overhead, production overhead has to be absorbed on the basis of normal capacity. If normal capacity is equal to actual production, then per unit will be normal capacity. If actual production is greater than, if actual production is lower than the normal production, then again it has to be on the basis of normal production, right? And the remaining balance will go to the P&L as an inefficiency. If actual production is higher than the normal production, it has to be allocated and absorbed on the basis of actual production, right? Is that clear? Is that clear, friends? Then we discussed cost formula. If the inventory is ordinarily interchangeable, then either you can apply historical cost method or non-historical cost method. Historical cost method is FIFO or weighted average. Non-historical method is retail sale price method or standard cost method. LIFO method is not allowed. If inventory is specific, like projects, in that case, you have to apply specific cost identification method. Then we talked about net realizable value, which is estimated selling price minus estimated cost of completion minus estimated cost of transfer, which is selling cost, right? This will give you NRV. If NRV is lower than cost, then it has to be measured at NRV and impairment is required to be charged, right? Right. And friends, if I talk about, so Mr. Hari, actually the name which is getting in the dashboard is Mr. G. Okay. So thanks, Hari. So guys, if I talk about NRV, so NRV is a net realizable value and entity specific value, right? And the another thing is, if it is a finished goods, it has to be measured at cost or NRV, whichever is lower. If it is work in progress, it has to be measured at cost or NRV, whichever is lower. If it is raw material, it has to be measured at cost always. But if raw material, if the finished goods, the value of the finished goods becomes less than the cost, in that case, cost raw material has to be measured at replacement cost, right? And whatever impairment is there, it has to be recorded. Is that clear? Then we talked about some disclosures. So I want to just So thank you, Purvi Ben, and thanks for your this wonderful feedback. And he has written that all topic by heart now. All slides go through by eye through mind. Thank you, Sarji. Also, you have summarized very nicely. Blessed to have you. Thank you, guys. Even I am blessed to have you as a student or participants. Thank you so much, guys. Take care. Stay safe. Stay happy. Bye bye.